Most traders are reading the market with one eye closed. They look at price. They study the candle shapes. They draw their lines. They watch their indicators blink. And yet the big move still catches them off guard. Either they're not in it, or they're in the wrong direction when it launches. They sit there afterwards, staring at the chart, thinking, I saw that level. Why didn't I take it? And the answer is right there at the bottom of their screen, in the one piece of information they trained themselves to ignore. Volume. Here is what most traders never truly understand. Price tells you what happened. Volume tells you whether to believe it. Price is the headline. Volume is the evidence. And right now, almost every trader you're competing against is reading only the headline. By the end of this video, you are going to know 5 specific volume signals that appear again and again in every market, on every time frame, before the big move unfolds. Not after, before. These are not secrets. Professionals have known them for decades. The only reason most traders don't use them is that they were never taught to look. That changes today. But first, understand what volume actually is. Not how a textbook defines it, but what it means in real terms. Volume is the number of times a financial instrument, a stock, a currency pair, a futures contract, changed hands during a given period. If you're looking at a 1-hour candle and the volume bar beneath it is large, it means a lot of people were actively buying and selling during that hour. If the volume bar is small, very few people participated. That distinction, how many people showed up, is the single most important piece of context that price alone can never give you. Because a price that moved on massive participation is a completely different animal from a price that moved on almost none. Volume is the truth meter of the market. An amateur watches the candle. A professional asks, who was behind it, and how many of them were there? Let me tell you about Rami. Rami had been trading for 3 years when I first came across his story. He wasn't a bad analyst. He understood support and resistance. He could read trend structure. He was patient enough to wait for levels. His win rate sat at around 50%, which should have meant he was at least breaking even. But he wasn't. He was losing money. Slowly, consistently, like a leak he couldn't find. After 18 months of this, he went back through 6 months of his trades and looked only at one thing. Had he paid any attention to volume before entering? The answer, in every single case, was no. He had entered breakouts without confirming participation. He had held through pullbacks without knowing if sellers were actually committed. He had bought into moves that looked strong on the candle but were running on almost no volume at all, which meant they had no fuel and were about to stall. Over the next 3 months, Rami added a single rule to his existing system. He would not enter a trade unless volume confirmed his read. Nothing else changed. Not the levels, not the time frame, not the risk. Just the volume filter. His win rate climbed from 50% to 61%. His average winner grew because he was no longer getting trapped in moves that collapsed the moment he stepped in. His profit factor, the ratio of total profit to total loss, jumped from 0.9, where he had been losing money overall, to 2.3, where he was building his account for the first time in 3 years. One filter, 5 signals, 3 months. That was the entire difference. Here's the math that makes this concrete. If your system has a 50% win rate, and your average winner equals your average loser, your profit factor is exactly 1.0. You break even before fees. Add volume confirmation, and eliminate only the trades where volume contradicts your entry, and even if your win rate only climbs 10 percentage points, the quality of what you're trading changes entirely. You stop entering moves that were already exhausted. You stop chasing breakouts that were always going to fail. You stop holding through pullbacks that were actually reversals in disguise. Every one of those 5 signals is a filter, and every filter you add to a system is a dead weight you remove from the account. Now here's what makes this difficult, and I won't tell you it's easy because it isn't. Volume is invisible to the emotional brain. Your amygdala, the primitive part of your mind that detects opportunity and danger, responds to movement. A candle shooting upward fires the same neurological response as a predator breaking into a run. Your instinct says, follow it or you'll miss it. Volume is static. It sits at the bottom of the chart in bars that don't move dramatically. that don't trigger the same visceral reaction as a fast-moving price candle. Your brain is evolutionarily wired to track what is moving, not what is confirming. This is why amateurs chase price and ignore volume. It isn't laziness, it's biology. And the professionals who learn to override that instinct and read volume before price are the ones making money from traders who haven't. An amateur follows the candle. A professional follows the conviction behind it. So here are the 5 signals. Write them down. Put them in your system. Test every chart you look at this week against all 5. The first signal is the exhaustion spike. This is a massive surge in volume, typically 2 to 3 times the average, that appears at the extreme end of a long move, either at a top after a sustained rise or at a bottom after a sustained fall. What it means is that the final wave of participants has entered the market all at once. The buyers who were watching from the sidelines, afraid to miss the move, have finally capitulated and jumped in, right at the top. Or the sellers who were panicking, afraid of further losses, have all hit sell at once, right at the bottom. When everyone who was going to buy has already bought, there is nobody left to push the price higher. When everyone who was going to sell has already sold, there is nobody left to push it lower. The exhaustion spike is the market's way of printing the words, "This move is finished," before price has even begun to turn. An amateur looks at the huge candle and sees momentum. A professional looks at the volume beneath it and sees a crowd that has already run out of road. The second signal is the low volume breakout. Price moves above a resistance level, a price ceiling the market has tested and failed to break through before. And the candle looks convincing. But the volume beneath it is thin, lower than average, lower than the volume that appeared on previous tests of the same level. This breakout is a lie. Without participation, there are no new buyers committed to pushing price further. The breakout moves into clear air for a moment, triggers every amateur's FOMO, their fear of missing out, lures them in, and then collapses back below the level it supposedly broke. The move trapped the impatient. An amateur enters the breakout because price crossed a line. A professional checks whether the market actually showed up to support it. The third signal is the high volume breakout, and this is the one you have been waiting for. Same key level, same breakout candle. But this time, volume is 2 times, 3 times, sometimes 4 times the recent average. That explosion of participation tells you something fundamental. Institutional money, the large professional funds and traders who can actually move markets, has decided to commit to this move. They cannot hide. When large players buy or sell in size, the volume bars expose them. The high volume breakout is not a trap. It is a launch. It is the signal that separates the breakout most traders chase and lose on from the breakout that actually runs. Write this down. Price action tells you where the market went. Volume tells you who decided to take it there. When the big players move, volume spikes. That spike is your invitation. The fourth signal is the quiet pullback. The market has been climbing. Now it begins to dip. Price falls for a few candles, sometimes several days, and every amateur who is long starts to feel uncomfortable. Their brain interprets the red candles as a threat. But look at the volume. It is shrinking. The bars are shorter with every candle that falls. That means the sellers driving this pullback are not committed, not numerous, and not powerful. They are not reversing the trend. They are taking small profits or catching their breath. When sellers are truly in control, volume expands on the way down. You see large red bars with rising volume. When volume shrinks on a pullback, the trend is pausing, not ending. The quiet pullback is where professionals add to their position. It is where amateurs panic and sell. And it is almost always followed by the next leg of the original move. The fifth signal is volume divergence. And this is the most important of all 5. Price makes a new high. The number on the screen is higher than it was the last time the market reached a peak. But the volume bar beneath that new high is smaller than the volume bar that supported the previous high. Fewer participants showed up to make this new record. The move is losing internal strength even as it appears on the surface to be getting stronger. This divergence, when price rises but volume falls, often prints weeks before the reversal that blindsides the market. It is the market whispering a warning that almost nobody is trained to hear. The crowd celebrates the new high. The professionals read the volume and begin preparing for the turn. Volume is not a bar at the bottom of the screen. Volume is the heartbeat of the market, and these 5 signals, the exhaustion spike, the low volume breakout, the high volume breakout, the quiet pullback, and volume divergence, are the 5 moments when that heartbeat tells you, clearly and in advance, what is about to happen next. The big move was never a secret. It announced itself. It always does. It prints in the volume before it ever prints in the price. The traders who get caught off guard, who say, "I didn't see that coming," they were looking at the right chart. They were reading the wrong line. From this moment forward, every time you look at a setup, before you look at the candle, look at the volume beneath it. Ask one question. Does the volume confirm what price is suggesting, or does it contradict it? If it contradicts it, you walk away. If it confirms it, you have moved from trading what you hope is happening to trading what the market is actually telling you is happening. That is not a small distinction. That is the entire difference between chasing and reading, between guessing and knowing. Volume creates clarity. Clarity creates conviction. Conviction creates trades you can hold without fear. In the next video, we go one level deeper into how professionals use volume at specific price levels, called volume nodes, to identify exactly where the market is likely to reverse or accelerate. If you want to know when the big move is not only coming, but where it will pause and where it will run, subscribe now because that is the next step. And if this video gave you something real, something that changes how you look at a chart, drop the number of the signal that hit hardest in the comments. I read every one. Volume is the truth. Price is the story. Read both, every time.